first, ladies and gentlemen, thank you for attending. First, it just leaves me to say good afternoon or good morning, depending where you are in the world. I know we have a lot of attendees from Latin America joining us today, so good morning in your case, as it might be. And welcome to the Block Asset Management's latest webinar entitled Digital Asset Market Review 2022, Key Events, Strategies, Lessons Learned. What can we expect for 2023? For those of you that don't know me, my name is Kevin Ballard, and I'm the co-founder of Block Asset Management. For those of you who are not familiar with Block Asset Management, I'll briefly explain. Block Asset Management, or BAM, as you'll hear to us commonly referring to ourselves, are an award-winning Luxembourg AIFM, or Alternative Investment Fund Manager. And essentially, we act as an institutional-grade risk filter in the digital asset space. And our job is to identify the best-in-class managers for funds, and 4 such managers are joining us on the call today. So we're very lucky to have them on board. In 2017, Block Asset Management launched the world's first digital assets fund of funds. The fund, Blockchain Strategies Fund, is now just short of a 5-year trading history, having launched in January 2018, or December 2019, it's actually live. Your invite to that 5-year party will follow in the post, ladies and gentlemen. Whilst I'll be your moderator today, I'm very pleased to be able to say that I am joined by 4 industry experts. You can see them online today. The 4 digital asset managers will all be sharing their thoughts and their knowledge on the events within the digital asset market this year, both the good and the bad, and there's been plenty of both. We're going to discuss where they see the market currently and their expectations for Q4 and beyond, which I know from our network members, we've seen a lot of inquiries about what is the expectation for next year. So I guess the first thing for me to do is ask each of our expert panelists to give us a brief introduction to themselves and the fund that they represent. I guess the best way to start is in alphabetical order. So Alon, could you just introduce yourself, please?
Yeah, thank you very much, Kevin, for having me. First of all, so my name is Alon Carniel, and I'm the fund manager of Algos. Algos is a fintech company working in digital asset space since 2017. We are a wholly owned subsidiary of another company working in the traditional asset space. At the end of the day, what we do is develop a trading strategy. This is what we are good for. We started off our journey in 2017 as a market makers in this field. Back then, we saw the opportunity with the ICO boom. There was not much liquidity back then, though. So we decided it's time to wait. We will not start with our trading strategy back then. We started providing services. We learned a lot about the market by that. And in 2019, when the liquidity started coming into the market with big institutional coming and investing mostly in the big project, we thought it's a good opportunity to try our power. For us as a company, as a systematic trading company, the mix of a place or a space, an asset class which has a lot of volatility and which has a lot of inefficiencies is like a playground for a company like us. This is what we like. We like the data, we like the statistics, and to work by them. Our funds have been operative since April of 2021. Our strategy were launched a year before that. We try on our strategy 1 year before we go to the market. And since then, we've been doing quite good for ourselves, where our leading fund is shortlisted to HFM Award for Crypto Fund of the Year, which will take place in September. And this is us. As for myself, I'm coming from the business side. I've been in the fintech industry for a long while. I've encountered Bitcoin first in 2014, opened my first, we tried to open our first Bitcoin business back in 2013, bringing the first ATM to Israel. Nobody wanted to touch it back then, but we knew it will come to the place that we will touch it again. And this is what we did in 2017. So this is in short about me.
Excellent. Thank you, Alon, and congratulations on the award nomination as well. I did see that.
Thank you very much.
I'll pass over to you, Hans.
Yes, thank you very much, Kevin, and great for being here. Thanks for having me. So my name is Hans Diederen. I'm a Dutch national living in Dubai since recently. I've actually spent the last 16 years in Asia Pacific, Singapore, Hong Kong, and mainland China. And I joined Apollo Capital late last year. I've been in TradFi myself. I've been in traditional banking, private wealth management for the last many years in roles in Asia, as I said. And I'm now basically I started focusing on promoting the funds for Apollo in Southeast Asia, but since recently as well, then in the Middle Eastern region. So what is Apollo? At Apollo, Apollo is actually Australia-based, Melbourne-based, specialized digital asset fund company. We were founded in 2017, launched our first fund in February 2018. So we have quite a long track record as well of about 4.5, 5 years already. And we basically deploy different strategies. So we very much believe in active and professional management of our funds, of the asset space. We have both market neutral strategy that we deploy, as well as a multi-strategy for our flagship fund, which is called Apollo Capital Fund, which does have exposure to Bitcoin and Ethereum and market neutral. And we have a long biased, that's a new fund we listed only this year, we launched only this year. That's a fund that is basically focusing on crypto only, long bias crypto, without exposure to Bitcoin, Ethereum, and market neutral. And our market neutral strategy is basically based on US dollar stable coin yield farming, and that's called the Apollo Capital Opportunities Fund. So we very much believe in digital assets as a new asset class, and the active and professional management of that is a key kind of differentiator. Our funds because we believe as well investors should have a possibility to get in and out of the market as they wish. So we offer monthly liquidity, which also means that about 90% of our funds that investors have given us is actually invested in tokenized listed securities.
And so when I said good morning or good afternoon, I should have actually included good evening and good night for those in.
Correct, yes. The evening has started.
In Asia, so much appreciated. Matt, over to you, my friend.
Yeah, thanks, Kevin. Thanks, Manuel, for having me. Hi, everyone. I'm Matt Shapiro. I'm a partner at Multicoin Capital. Multicoin's a thesis-driven investment firm. We focus exclusively on crypto and tokens, very much crypto native, which I think is a huge advantage. We are quickly coming up on our 5-year anniversary in a couple of weeks, which is exciting, although sort of feels like 35 years, I guess, in the regular world. I think crypto is kind of like dog years. We manage several billion across a flagship hedge fund and a series of venture funds. So we have a very holistic view of the space because we invest across both the public and the private markets of crypto, predominantly in tokens. We really focus on thesis formation, where we dive really deep to gain conviction, to understand where the space is going, and then try and find and own the assets that are sort of best positioned in that version of the world. We own them in size and then look for them to compound over long periods of time.
Excellent. And then last but not least, Samed.
So Samed, I'm a portfolio manager in the digital assets fund in Altana Wealth. At Altana, we were pioneers in investing in cryptos back in 2014, when Bitcoin was around $400. So we launched our kind of Bitcoin and Ethereum and the two other largest market cap cryptos when Bitcoin, I think, was around $400. From there, we evolved into providing a market neutral strategy at the beginning of 2017, whereby we provide liquidity to margin traders on top exchanges, strategy that has been quite successful, like with no negative months, no impairment on any of our loans, and just obviously was superior to some CFI propositions out there, especially during this year. And from there, we kind of evolved into the risk spectrum. And this year, we launched the broader digital assets fund, which I'm co-managing with Roland, who's not here today. We were quite lucky to launch mid-June, when pretty much the bottom of the market. And this new strategy will pretty much focus on everything but Bitcoin. So quite similar, frankly, to what Matt was describing. We take a fundamental kind of approach to the market, but by first looking at layer one, so the blockchains, then we drill down within their ecosystems and we look at fundamentals and narratives. We have in-house tools such as smart money tracking to kind of reduce our beta or macro exposure. But we look for medium to long term in terms of our investments. And frankly, currently we're 100% in liquid tokens because we see there's a lot of value being in liquid versus VC tokens at the moment. So that's what we do at Altana Wealth. Yeah.
Very much. So yeah, that's the formalities and the introductions over with. So I guess we can begin and start grilling you with all the topics of questions. So I guess one place to start really. So I guess unless you've been living in a cave or under a tree in outer Mongolia, you'll have probably heard that there's been a major event this week. That event is today, which was the launch of Ethereum 2.0, or more commonly known as the merge. And it is no coincidence that we're hosting the webinar today. You know, we can't claim to be geniuses. There was always the expected or anticipated date of the 15th of September. And we thought, therefore, that would be a good day to host the webinar. So the Ethereum merge proceeded this morning. And if I just give a very brief, I won't go into too much detail. If you want more detail, email us and we can provide more detail. But just to summarize, Ethereum has changed its blockchain from the existing proof of work consensus and has merged and is moving towards what they call a proof of stake consensus, or to those in the industry will know, refer it to as the beacon chain. Whilst this does not immediately reduce gas fees or shorten the transaction time, what it will do, and they will come over time, that's what's known as sharding over time, what it will do is it will reduce energy consumption by, I believe, over 99%. Now, person correct me if I'm wrong, but in this ESG conscious world that we now live, this is great news. You know, it's always been a bugbear or a pinpoint for Bitcoin and the mining of Bitcoin for the energy consumption, etc., which is, it's not all technically true, but I'm not going to go down that rabbit hole right now. But this is certainly great news for what is the most widely used blockchain in existence. And what this does mean is it adheres to the ability or the scalability of Ethereum and its network. So on that, my first question to the panel, and I'll open this to you, Matt, I guess, first, if we start with yourself, is how important an event is this, the merge or Ethereum moving to 2.0? And to what level or degree do you think it will impact the market? So I guess the question is, has this been priced in? Was it a buy the rumor, sell the news kind of event? Or is Ethereum grossly undervalued? So if I start with you, Matt, fire away.
Yeah, I think, and my view here may differ from others on the call, which
we like that. We like that. Don't worry.
We'll make for a good discussion. So I think it feels a little bit like a crowded trade. You know, everyone sees this almost as like an event-driven catalyst, and I think most groups have been sort of positioned long going into the merge. And it is exciting. Don't get me wrong. It's actually a big upgrade. It's a good proof point. I mean, you're moving. You know, you're making real upgrades to a massively working thing, and it really hasn't been done before. So it is exciting. I do agree with you though, and I think this gets lost on a lot of folks. Like, unless you're like an ESG guy or girl, like this doesn't do anything. It's effectively bringing Ethereum on the same playing field as every other next generation smart contract platform that launched after it. So it matters if you care about ESG, but it doesn't solve a lot of the problems that, like, frankly, need to be solved, which is it doesn't impact scaling, doesn't increase throughput, it doesn't do anything for the fee markets, right? So I think it's a good proof point. It's a good. I'm glad that it's happening, but it doesn't solve the problems, and I think that message sort of gets lost in it. So the way that I look at it is, look, it's good. It feels a lot like uncompensated risk, to be quite honest with you. Everyone sort of expects it to work. There's obviously some non-zero probability that it won't. There's all these weird things that can happen, and replay attacks, and all the exchanges are going to shut off withdrawals, and you're going to have a proof of work chain. Like, it's messy. We haven't had a fork really in the system since, Bitcoin Cash back in
Right, yeah.
2017.
Yeah.
So there's a lot of things around the edges that, I think most people are not thinking about. And if all goes right, like nothing kind of really happens. So it feels a little priced in, and there's a lot of ways it can go wrong. So it just depends on how folks are going to manage their exposure.
Excellent. Hans, do you want to add to that?
Sure. I think when it comes to, if you would have asked us yesterday the question, because you have a great timing today with the merge happening this morning, at least this morning Dubai time, and we would have said that it is priced in because this was a known event. This was, I remember myself in 2017 with Vitalik in Singapore at the time. He was actually lecturing at National University with the computer science people about the sharding technology and the way he wanted to change the Ethereum, blockchain. So that it was a known event. I think definitely, what does change, I think now with proof of stake is that there will be, the issuance of Ethereum is going to change. So there is an impact on the supply side. Of course, we don't know what that means for the demand side. We don't expect prices to immediately veer up and the whole crypto market to start jubilating again. Although having said that, I think it gives some peace of mind that actually this event was successful, at least so far successful, because I think the risk would have been very much to the downward if something would have gone wrong today.
Excellent. And Samed?
Well, I kind of echo both points, frankly. I mean, I see the flip side of Ethereum's kind of overhyped narrative, which is obviously the fact that it doesn't solve any of the current problems, which is big gas fees, right? We're very far away from the 5 cents per transaction kind of fee that Vitalik has sold to everyone, right? But also we're also not there yet in terms of implementing the sharding solutions, which will obviously deal with scalability. But I think it's nevertheless a huge step and a big credibility kind of plus to the entire space. I mean, we kind of moved, as I think one of the Ethereum Foundation guys has put it, we kind of changed the engine of the plane whilst it was flying, right? So we moved from two different consensus mechanism of something that was completely working, a blockchain with multiple DeFi protocols and many other projects built on top seamlessly. This morning, I mean, around 7 a.m. London time, I'm based in London, all of a sudden we saw that panda saying, that's it, proof of stake activated, and that's it, and everything went on. So I think it's a big plus to the Ethereum community. It adds, frankly, from a TradFi perspective, not from the crypto community perspective, it adds that legitimacy and kind of, as I said, credibility to the entire space. Now what's next? What's next, frankly, is I think a scalability and obviously reducing those gas fees. But I think, as Vitalik has put it a few months back, etc. Why I'm citing Vitalik because he speaks in my opinion, for the Ethereum project, and he wants to embrace layer 2s on Ethereum because they obviously are cheaper, etc. So he wants Ethereum to be the settlement layer of the Internet of Things, really, right? That where you could obviously then have other blockchains such as layer 2s where you do the transactional part of it. So from that perspective, I think it's a wait and see kind of how it's going to play out, right? Would people still want or prefer directly you're doing transactions on layer 1s or alternative layer 1s, or will move to layer 2s on Ethereum? Some of them are quite successful, frankly. We look at Optimism and Arbitrum. The amount of ecosystem adoption that they have seen this year in comparison with alt layer 1s is humongous. It's quite good for the Ethereum ecosystem as a whole. So it's good, I think, for what's happened today, the merge, the success of it for the entire crypto space. For Ethereum as a chain, it's good but not enough, as we were saying with Matt. I think we need to see better or more kind of features coming through in terms of gas fee reduction, etc.
Excellent. And I think, Alon, I don't think we've come to anything to add on to that. I know we've been through a lot there, but I'm sure you have some comments.
Yeah, they said most of it. That being said, I want to state two things. I think it's too early in the game to call what the effect will be. such an event, it's a huge event, and we need to understand that. And in terms, I compare it somewhat to, let's say, Bitcoin halving. Okay, every time we're waiting Bitcoin halving, nothing happens the next day, right? There's an anticlimax. We all wait for something to happen, nothing happens, and then the year after the halving, we know we are regular. We know what happened with the cyclicality in the market. So I don't think, maybe it was priced in, but I don't think we see in this time the real effect of what we're seeing here, of what was done here. Another thing is, we talked about ESG. Listen, when I'm going and we're talking to VCs in the US, we saw they are looking for ESG compliant companies to invest in. This means that a lot of smart money was out and not invested in blockchain protocols or blockchain apps that's sitting on Ethereum because it was not ESG compliant. So there's a lot of possibility for smart money to enter the market. And we are, hopefully we'll see that. We see that with, parties like BlackRock coming in and other parties entering the market at this time. Goldman Sachs just did its, first transaction on Ethereum 3 months ago. I think they were waiting for this, okay? Because they are, the big brother. They're trying, to like help the environment. And in that sense, I think that we are still far away from understanding like what the consequences of this event has been, other than, of course, saving electricity.
It's almost as if you'd read my notes there, I'm afraid, Alon, because I was going to myself very similar to the halving in Bitcoin, because you have this super hype driving up to the halving. And as I said, I use that phrase, is it sort of a buy the rumor, sell the news? Do we see, typically in the traditional financial world, you'll see where major companies have their earnings reports, and it's very similar to that scenario in the run up to earnings. Do I hold through earnings, or do I sell pre-earnings? So it's a similar kind of thing, and I myself would use that same analogy, that it's quite similar to the Bitcoin halving, that you have a hype and then nothing happens. It's a bit of a damp squib afterwards, nothing. But what we do see, as you're right, the cyclical, it's 8 or 9 months later, it then flows and the drive occurs as it sort of sinks in, and we see the cycle move. And I think with the scenario here, the roadmap is written, and this is really just moving to 2.0, if we'll call it, or the merge. What it does allow now is the sharding and the next steps and the next stages. And when gas fees are reduced and when transaction times are reduced, then you'll see, if Vitaly's vision comes true, we'll then see major changes and see major movements in the price of Ethereum. So I like that analogy, and it's one that I'd noted down here myself. So thanks for stealing my thunder.
Sure. I totally agree. I just need to add to that. I think, it all passed like so easily. So we take it for granted. But if there was a failure here, it was a catastrophe for our space. Catastrophe. And the important thing that it passed so easily, this is the thing, okay? People, it's been in the works for 3 years. It's really amazing, as I see it.
Yeah, well, a lot of people have got their 32 Ethereum on lock now, haven't they? So a bit of Ethereum selling going on. Okay, let me mix it up a bit. So we'll move on from, what we'll describe as a very positive event, albeit maybe not feeling the benefits right now, but certainly I'm sure we all agree there are definitely going to be benefits down the line from what's occurred. So let's look at the other side. Let's not shy away from some of the topics that, for want of a better word, catastrophes that have occurred this year. Okay, and I know the audience members will be glad to hear us address this. And here we don't hide away from these matters. When there's an event that occurs in this space, or an issue in the space, we need to address it, talk about it, what occurred and why, and how do we learn and move on. So I don't want to focus on the macro cloud that currently hangs over all asset classes. So we're not going to touch on the war in Ukraine, inflation, interest rates, etc. What we want to do is focus on, let's say, the negative events that have impacted or are unique to crypto. What events that have occurred this year that can be seen as negative for crypto. And this is a question and a point that's been led by a lot of our network members, and a lot of our investors. So if I go through, namely, these would be the collapse of Terra Luna. So, a top 10 by market cap digital asset. The collapse of the CeFi platform, Celsius. and the collapse of billion-dollar crypto hedge fund 3 Arrows Capital. There's 3 examples of major negative events in this space that all occurred within the first 6 months of the year. So my question is, and I'll throw this to you first, Hans, how have these events impacted the market? Has the asset class learned from these mistakes or these errors? And is the market stronger, more resilient as a result? So I'll hand over to you, Hans.
Yeah, it's certainly been an eventful first couple of months of the year. And I think indeed the biggest shocker was the kind of complete collapse of the Luna Terra platform, and that included the UST, the stablecoin DPEG. I think that one has had a lot of impact on the market sentiment as well. Investor confidence has been dented as a result. And I think also what investors became more aware of again is that there was so much leverage. There was so much leverage that was taken. So the deleveraging process was extremely painful because it just led to forced liquidations one after the other, which meant also the very liquid coins and tokens were actually, the acceleration in the price decrease results in that. So, I think, yes. So what have we learned, or what do we see? We, of course, the impact on the funds has been, even if the impact has been negative, funds had exposure to Luna or to UST. I think the way that Apollo, we manage our assets basically hasn't changed, which means you have a very disciplined portfolio construction. You make sure you have your position sizing right, your risk management in place, so you at least don't get overexposed to a singular protocol or blockchain or market or liquidity pool, for that matter, for the market neutral strategies. So yes, have the markets become more resilient? Are they more resilient? There probably will be. It's still very immature. There's still very immature markets. So, even if there will be, the volatility will unfortunately not disappear, and will probably continue to be as we have seen it in the past. There's lots of people saying now, well, with ETH, with the staking, the returns are so much better. But at the end of the day, if you get leverage in the system and with increasing interest rates, basically there's not even that much margin left. So it's always a matter of, and it's very hard to see also because the regulation is not clear enough yet in certain instances or many countries, to basically conclude now that the markets are more resilient. Yes, in term there will be, we have an adoption phase that we're going through, and time will only tell if the volatility and the spikes we have seen upwards and downwards actually will be more leveled.
Excellent. Alon, anything to add?
Sure. It's been a couple or 3 very bad cases. I think they drove out a lot of people or a lot of smart money again that was almost ready to enter the crypto market, and suddenly they face such projects like Celsius and like Luna, which, if you would have looked at them and you would have, understood that there's like protocols like Encore that providing 70% interest on a coin, like where can you get 70% interest? It's unreasonable. So it's something that people, when they enter the market, they should learn about the market and understand what they're doing. There is no reason why someone can provide you 17% interest, okay, without doing something which is very weird, okay, because you can't get there anywhere, okay. I'll tell you, when companies like that, I don't think they began as a scam or trying to take money from people, not in Celsius for example, but it's tempting because you have a lot of money coming in, and the project begin to there's exponential growth, where you move from a place where you manage, I don't know, a few $100,000 million to a few billion dollars, okay, in 2-3 years, it takes you places. Now, I'm not saying, that's of course, anywhere, helping with them with the, it's not helping, sorry, trying to say that they went there because of growing pains, because the fact that keeping, industry, sorry, I lost my line connection. Sorry, I'll take it again. What I try to say is in Celsius, okay, when they are playing with the money, when they did the, sorry guys, I'll let you take it because I lost my train of mind.
Right. Matt, I'm sure you've got something to add on that.
Yeah, I mean, I tend to agree. Like, look, all of these had massive impacts on the market. They're all somewhat distinct, but they're obviously extremely interrelated, which has created sort of the contagion that we see. Luna, Luna was always destined to fail. I mean, uncollateralized algorithmic stablecoins don't work. Like, they will never work, probably. Like, they've never worked in the past. Like, Luna's not the first instance, right? Basis and empty set dollar and Ampleforth and Basis Cash. I mean, there's a bunch that like nobody talks about because they didn't work. And if you did the work, you could see that. And Luna was no different, other than its ability to market and grow, right? And then the worst thing about it is that it's a shame that it got as big as it did. But like, I can't really say that, we're surprised by the outcome. And if you did the work, you were able to at least avoid a direct hit there. Celsius, like, I also don't think is a surprise to anyone paying attention, to be honest. Like, their address is on chain, and they were doing egregious things with customer funds and liquidity mining, crazy, doing degen things that they shouldn't really probably be doing. So again, really unfortunate. And I certainly feel for the users there, but, I think you had an ability, given the open nature of crypto, to sort of get a look inside at what was going on, and at least be able to somewhat evaluate that risk if you were willing to do the work. So the biggest shock to me is really 3 Arrows, to be quite honest. I mean, for all intents and purposes, like, they were good guys and like ran their own capital, and they've been around forever, and they're obviously very smart, and, didn't take outside capital. And it turned out like that perspective was just absolutely wrong. Like, it was anything but. And, they turned into kind of, I would equate it to like the Archegos of crypto, right? Like, Bill Hwang blew up his family office last year because he took a bunch of leverage from a bunch of primes that didn't talk to each other and didn't understand the credit risk, and sort of, the wind blew the wrong way and knocked the whole thing over. The big difference though here is size. Like, the 3 Arrows debacle was not that much smaller than Bill Hwang, to be honest. There's maybe 25%, maybe 50% of Bill Hwang. But crypto is like a fraction of the equities market. I mean, you're talking like 1-2%. Like, I don't know, that's probably how big crypto is relative to the equities market. So the feeling that we've got from it is just much more pronounced, and it just rocked the industry, because you have groups with billions of dollars of exposure, that have collateral, and these guys aren't calling them back. Well, they're going to sell because they need to recoup losses, and they're not going to sell in a way that is like not going to drive down the market price. Like, you need to get out first. And I think that is what created this cascading effect, which just rippled through the whole industry. And I think the entire crypto market today and over the last year has been driven by these weird capital market shocks. So that's sort of the most, I think 3 Hours is probably the biggest surprise. The good news, sort of like, what have we learned, which I think was the second part of your question, Kevin. I think the market's stabilized. Like, I think it seems unlikely, don't quote me on it, but it seems unlikely that there's like billions of dollars waiting to be market sold immediately, right? There's no new names that sort of came out that people didn't know, or media reports didn't have. The liquidation for 3 Arrows is, probably going to take a while, to be honest with you. And it's going to be transparent how it unfolds so people can react. The news will probably get worse. Like, as these lawsuits come out, as you read what's going on with Celsius, like, all that stuff is probably bad. Maybe that's priced in, to be honest, but maybe it's not. But the key positive for me is just the performance of the things in the space that people have built, like the DeFi protocols specifically. I mean, Compound, Aave, Maker, Hubble, Jet, like, all of these held up exceptionally well. Like, they faced the same stress test that the broader market faced, and have operated fairly consistently. And the cracks in the ecosystem, interestingly, were not the protocols, and it was not the code that anyone built. Like, it was the poor human judgment around the edges. It was the fuzzy qualitative factors that, evolve around trust. And like, that's where the system failed. Like, that is not a crypto failure. Like, that exists in traditional markets. Crypto can change that. And I think this sort of proves that a sustainable, sort of well-built, decentralized protocol can be extremely, extremely powerful. And I think that's the key takeaway for me.
Excellent, great answer. And Samed, anything to add? Although I know Matt's been very thorough there, but have you anything to add on the matter?
Yeah, I mean, frankly, I want to stress on what just Matt was saying at the end here. I mean, DeFi. What a big lesson here is that really DeFi is superior to CeFi, right? First of all, we need to compare apples with apples, right? We cannot.
You know what, Samed, that's a great point, and I was going to come to it later. So carry on with that. But can you just, for the sake of the audience, just explain now? Say me coming to it later.
Yeah.
Just explain the difference between CeFi and DeFi for anybody that doesn't know. It's a great time to do that.
Yeah, I mean, DeFi, decentralized finance, is peer-to-peer lending on a platform that's built on a decentralized blockchain, really. And CeFi is a centralized finance lending entity, that's governed by a corporation, really, right? So you have entities with different, obviously, vested interests, etc. So. And what we were describing earlier on with the Celsius debacle really is obviously first of all, finance 1.0 is how you match your liabilities with short-term liabilities with your assets, right? And they did not do that, right? So they were, as Matt was saying, they were doing some degen stuff with their short-term liabilities, which is their retail market money, really, funds. So that's to me is something that only a CeFi entity could do, because DeFi, decentralized finance, such as the protocols we were mentioning earlier on, like Avrien and Compound, they actually work perfectly. So exactly the same model, lending, right? One is centralized, the other one is decentralized, peer-to-peer, built on a blockchain. The one that's decentralized, you work perfectly. Why? Because you have smart contracts that define the rules, right? And the collateral, so people who were over levered were liquidated on time, and the lenders got their collateral back, right? So you can't basically bribe a smart contract or take a phone call and ask to extend your credit line with them, right? As opposed to a centralized entity, you might call your buddy and say, hi, can I extend my credit line, with that much percentage point, with probably has happened with 3 Arrow Capital, etc. So that's why DeFi, I think, is superior to CeFi, and this debacle has showed us so. I think the other thing we haven't mentioned here is obviously what we say and always have said in crypto: not your keys, not your cryptos, right? If what happened with Celsius when they halted all those withdrawals, obviously everyone that's invested or that gave their bitcoins or cryptos or even the US dollars to Celsius, they did not know, or they haven't read that little star in the contract that says, in case of a bankruptcy or in case of market stress, you will not, we can halt the withdrawal. So basically your cryptos do not belong to you. And that's what we've been saying from the beginning with decentralization, right? So if you do self-custody and if you know how to do it well, then you own your cryptos. Nobody can take that from you. So that's also something I think important to take away from that. But I think more importantly, if we step back a little bit, all of these are kind of lessons, 100 years lessons that traditional finance, have learned throughout the time, right? We've learned it. Cryptos have learned it the hard way within a few months, right? Things like counterparty risk, things like collateral management, assets versus liability management, as I said, for the case of Celsius, things like, financial markets become illiquid during market stress and during bear cycles. All of this, I think, are good things, but we have learned them. I think we will come out, I hope, stronger, and the projects that in the next cycle that will not focus on rapid user growth at all costs, such as the Luna, etc. Will probably emerge stronger. And we should not be offering obscene yields just to attract growth, but we should think about sustainability, and we should manage those risks more responsibly.
Excellent. So I guess if I summarize some, then if we look at Terra Luna's collapse, we're looking at algorithmic stablecoins don't work. That's the summary for that. If we look at Celsius, we're looking at a problem that is unique to CeFi and not DeFi. It's a CeFi problem. due to maybe a combination of lack of transparency and unsustainable lending or irresponsible lending. And then in the case of 3 Arrows Capital, we're talking leverage and human error at the end of the day. So we have unique scenarios there, each of them very different, but kind of a perfect storm within, I think, 3 months of each other or 2 months of each other. We were hit with a triple whammy. It was sort of bang, bang, bang. But I think that the market has shown the asset class has certainly shown its resilience during that. So yeah, great comments. One point I will mention there, and having spoke about 3 Arrows Capital and the issue of leverage, Block Asset Management does not use leverage. So I'll always refer to that. We do not use leverage. And I think, correct me if I'm wrong, guys, it's pretty much the same with you guys as managers as well.
Likewise.
Yeah. I thought so. Excellent. It's one of our criteria when we review funds. So let's move on. We'll stay on that a little bit. I guess it's just an adaptation of that question is, how did this triple whammy in the first 6 months of the year, how did it affect your fund specifically? And are you doing anything different in the wake of these collapses? I know that somebody said, I can't remember who it was now, that no, not really doing anything different. It didn't really change. I'll open it to the floor. Did it impact your fund, and are you doing anything different in the wake of it?
So as I said before, it mostly impacted for us the raising. It's been harder to raise money because of that.
The more cautious market.
Yeah, very cautious market. People are afraid coming in, like smart money that was already there says, okay, they're taking back. And I don't think there's a reason to do that. You know, you should learn what you invest in, okay? Because, you know, Bernie Madoff did his scam. People did not run away from the capital market. It's just do your homework and look at what you're investing and learn and ask. For us, I should say we have like small exposure to projects like this. We're trading in our funds. We're trading almost the entire 50 assets in based on market cap. So we might have touched them, but in terms of how it affected us, it almost had no effect on our work. For us, we're looking at this, and I think which is a bit different from the other 3 fund managers. We are looking at this market as another asset class. Okay, as I said, we don't have any fundamental view on it. We are very big believers in this asset class, but we don't have any fundamental view, and we don't look at projects if the protocol is better than the other. We're looking at this as an asset class which has a lot of, as I said, inefficiencies and place where we can bring yield to our investors. So it's in that sense, we take position based on the liquidity and based on the market cap. So projects small in that sense, like Luna or Celsius, they have no big effect on our operation. And you know, it was seen in the results. We had like good month when those events occurred.
Okay. Anybody else have anything to add on that topic? So basically the news is everybody was unaffected, everybody managed and up as well. So that's good to hear. Let's move on to something with regards to the current market conditions. Obviously, a lot of questions out there, a lot of existing investors or potential investors are keen to know what's happening in the current market. Where are we in relation to cycles? You know, let's pose a question as, where do we see the current digital assets market relative to historic trends? And how much longer do we see a bear market continuing? And is the market turning? So I'll go with Samed. Do you want to add, Samed?
Yeah, I mean, obviously where we are in the current digital assets market, it's several factors that enter the equation here, right? I mean, but barring the macro environment, which we can talk about it later or never, because you didn't want to when.
No, feel free if you want to address it.
No, but it's probably boring. Everyone knows what what yields are doing, what US dollar is doing, what liquidity or illiquidity is doing to all risky assets. But I think frankly the digital asset space is still in a good spot relatively to the entire macro environment. I mean, we shook off levered mercenaries that were here to make fast money, not caring about the tech. We also these irresponsible players that have been largely, I believe, exposed. You know, 3 Arrow Capital. I don't think we will see another 3AC. Frankly, emerging post the Luna and Celsius debacle. Forced selling, in my opinion, has ended now. But obviously, currently we're still in a bear market. Is it due to idiosyncratic crypto factors? I think less so. I think it's mostly a dire macro environment. We're in it. I think we will remain in the bear market as long as liquidity and global money supply is shrinking. Right, cryptos are still regarded as a speculative asset, so it will perform as such. And in line with equities, right? So until we see next cycle of expansionary monetary and fiscal policy, I think we won't be in a sustained bull market. So all the indications now is that frankly, US dollar is king. The Fed will keep on hiking rates, and that will weigh in on sentiment across all risky assets. So is the bear market going to continue? I think so until at least Q1 of next year. Why do I think Q1 or March next year is a key kind of month? Because the winter months will be behind us. Here in Europe, I mean, you guys know that we have this energy crisis and cost of living crisis, etc. So we that shortage of energy uncertainty, I think, will be behind us by March. Also potentially inflation might or might have not peaked. Also potentially the yields would have inverted by then, meaning that people are inferring the potentially a reversal in the Fed policy. Although now it's clearly a no from what Powell said in the last Jackson Hole meeting. So it's a wait and see. Macro is dire. I think we should be cautious. We should not be zero invested, but I think we should bear in mind that we are still in a macro cycle and potentially just take some opportunistic plays here and there, some narratives, and there are still a few good narratives out there.
Excellent, Matt. I'd like your view.
Yeah, I mean, look, I don't. My crystal ball will say something different than your crystal ball and everybody else's. I don't know that anyone will be perfectly able to time markets. I'm hesitant to put a little too much weight on like the precedent here. I think it's very easy to say, oh, every 4 years, or you look back and the last cycle was this long and this cycle was that long. Like I get the human desire to want to do that, but like in crypto specifically, I mean, the market has matured so quickly that nothing is the same. I mean, the market participants this time around are not the same market participants the last time around or the time before that, right? The assets are different, the users are different, right? So I think looking at prior cycles to try and extrapolate the future can lead to really false precision, which I think can be dangerous. What I do feel comfortable saying is like there is a probably never been a bigger variance between what's going on in the ground in the private markets and like what the public market prices are saying, right? And I think in this industry, there's a lot of metrics you can look at. A lot of them are all by definition backwards looking, but the predominant leading indicator for these systems are developers. And you look where developers are building and what they're doing and the quality of them, and all of that is like going up and to the right. I mean, we have been fortunate to follow a lot of that talent, and we've backed the founders of FanDuel and the founder of Twitch and the founder of Resi and the founder of Scale.ai, all of these big Web 2.0 companies, massively successful people. I mean, these people were not building in crypto 2-3 years ago. Like they just couldn't. And so we see that flow, and like we see most of the projects they're building, like they don't even exist yet, right? They're still in the process of being built. But to see that pipeline of activity and the excitement around those teams and what they're building, I mean that gives us a lot of a lot of comfort in sort of where the space is going.
Excellent, Hans.
Yeah, I think a lot has already been said. I think it's very hard indeed, timing-wise. The sentiment needs a couple of catalysts, and it's very hard to predict where these catalysts will come from. We know longer term. If you go back to previous cycles, which definitely don't have to, show that grow, rinse, and repeat scenario that we kind of were used to. And you was used to different participants in each new bull and bear market. I think we do have to take some comfort that but still it can take a while to consolidate in a reaccumulation zone. You know that the Bitcoin price has been kind of now testing or retesting the like 2017 highs of between 18 and 20,000 for a few times, and it seems to be consolidating in that area. I think the successful ETH 2.0 merge today will also kind of give some comfort, at least, that, you know, the worst is behind us and we can start thinking and looking again into more positive scenarios. Having said that, though, I think it's also important to see that, you know, at this point in time, you know, the market cap is pretty much down. It's come down from 3 trillion to 1 trillion, with Bitcoin and Ethereum still taking 60% of that, which means, you know, there's also, like, on the sideline, there's a lot of money, but institutional investors might not be, you know, be touching it at this point in time, because either the threshold is too low for them to even engage in it. So it is interesting to keep on watching it, but I think you focus on who are going to be the winners, you know, in the areas that's from ourselves as well, from a fund perspective, in the key focus areas. You try to identify them and actually also use cash positions now to accumulate positions on the way down. So I think that's, I want to leave it.
I understand. Alon, anything to add?
As the guy said here, I don't, you know, we don't have any fundamental view in our company, and I don't think anyone can point out now, maybe backwards, but not forward, like, why did the bear market of 2018 stop? For you know, it's things are happening. We don't all have all explanation to that, but we should remember that even in this market, please remember that Bitcoin hit 20,000 first time. I think it was in 2020, right? And we're you know, now it's kind of the bottom, you know, somewhere at 18. So we're still in a very, you know, in a good environment where the bottom was the peak just 2 years ago. So we should have that in mind. And we're all the time saying to our investors, it's good to be in a place where if someone can, you know, hedge your position and save your money and protect your money in the bad times, okay, and keep you flat, because you want to be in the market when the boom begins again, okay, and then the 25% or 30% month will hit again, and as we know, retail are coming in only when it hits 60,000 again, okay. So we tell our investors, be there, find the places where you want to be, where people can protect your money, and then enjoy when the market hits again, because nobody knows when it will happen.
Have some skin in the game, never be fully divested.
Sure.
I'll stay with you there then, Alon, because I'm going to move on to the question. It will be, are there any sectors that you feel are undervalued or maybe set to evolve more rapidly, and why?
So I'll have to kick this to the guys, because as I said, we're as a company, we're more agnostic in that sense, okay? We see the opportunities in the volatility and in the inefficiencies. We're not looking, like, we're not segmentized. We're not looking at DeFi as a you know, as a special place to invest in, or in protocols. We're just look at the opportunity that they are there on the ground.
Okay, I think this is more a question for Matt, I think, with, you know, the fundamental sort of research and the investment thesis that you guys have, Matt. Is there anything in the space that maybe, I mean, you touched on there about the developments that are going on behind the scene, whether it be the infrastructure or anything else that's happening now, and the projects that are occurring and are not off the ground yet? Is there anything you feel is undervalued, or a sector that maybe is evolving more rapidly than any other, or an area that you're more excited about than others?
Yeah, I mean, look, I think there's no shortage of areas that are exciting. I think, you know, DeFi is probably going through like a trough of disillusionment, which is probably, you know, a good time to be sort of, you know, scoping out what's happening in that space, especially given the resiliency that we sort of talked about before. We've been spending a lot of time in areas that are sort of not intuitive, I think. One of those is things like minor extractable value, and then how that market evolves, and sort of like, you know, payment for order flow systems in the traditional world. You kind of have like a similar aspect in crypto. And that, you know, has real cash flows behind it, and it's going to have very meaningful implications on, you know, the existing layer one, how to think about them and how to value them, the new layer ones that have yet to launch. There's, you know, MEV infrastructure that's sort of being launched left and right, you know, by really talented teams. This is going to have a profound impact on things like staking derivatives, right? So that sort of that concept has, you branch out and it creates a lot of opportunity and there's a lot of interest. And I think it's generally underappreciated, I think, by the broader market. It's a little bit technical and nuanced, but I think overall it's underappreciated. And we spend a lot of time in like kind of net new weird things, to be honest with you. We like things like proof of physical networks. Helium, HiveMap are investments of ours that sort of fit in that category. It turns out that crypto and token incentives are a fantastic tool to incentivize, the build out of physical infrastructure in the real world. And there are lots of use cases where that is important. Anything that's by definition geographically dispersed, can potentially, have this model. And so I think we're just at the beginning of understanding how all that works. And I think that there's going to be, lots of other opportunities in that vein that we focus on.
Anyone to add anything on that topic before I move on? I know it's not applicable really to everyone if you have a niche strategy.
Yeah, I want to, let's say within the remit of our investment thesis, I think there's three things we're currently quite actively investing in or monitoring it very closely. That's one is the layer 2 rollups on Ethereum, basically, that are happening. There's a lot of development in the TVL growth. Different, Optimum and Arbitrum are very much leading the way there, but there's also a project like Boba and Metis and some others that actually, are trying to gain some good traction. Another area is on-chain derivatives. So we quite have, been very early in DeFi and derivative exchange of DEXs with derivatives on decentralized exchanges, options, perpetuals as well. And I think a last area is very much we call that the merge between NFT and DeFi, meaning, and we focus on the infrastructure only. We don't invest, we don't, use NFTs as collateral for loans, but there's a lot happening at the moment in the space where basically DeFi primitives can be used to get increased usability and liquidity. And for example, looking at the top NFTs, like the Bored Apes, etc., you can now more easily start actually, without having just sitting idle in the wallet, actually give it as collateral for lending and make some make some yield on the NFTs. And there's some very specific projects that are focusing on the infrastructure that we are very keen on and following on. And either taking an early stage soft agreement on as a small part of our portfolio, or if the token is already listed, then we would buy the tokens.
Excellent. I'll move to, I'm conscious of time that we've gone through an hour already. We've still got a couple here to go and maybe to open the audience. So we'll go another 15 minutes here. I think that's okay for everyone. I think one for Samed really here, probably a bit of a targeted question really is our network often have questions with regards to understanding fixed income type returns through staking or lending strategy. So, just like to ask the question maybe to Samed or to Hans on, how do you go about as a fund manager ensuring that you have secure fixed income type returns through staking or lending, and what are the associated risks?
Yeah, sure. I'll take this one. I think, well, yeah, that's part of the DeFi kind of investment strategies, right? So DeFi, which has taken the spotlight of summer 2020, right? When decentralized crypto exchanges and lending platforms, they gained a huge market adoption, right? Where we've seen Uniswap, Aave, Compound, but also we've seen all the centralized exchanges product offerings. Then obviously we've seen after that that things have evolved into double or triple digit yield farming returns for hungry crypto degens who essentially provide liquidity to these inflationary projects. So I think lending protocols such as Aave, they're interesting, but they provide single to double digit APYs depending on demand. What we have here, frankly, in Altana, we have found that there's a more sustainable and probably healthier way to generate market neutral returns via lending. Basically, what we do is we provide liquidity to crypto traders on top exchanges. And what happens is these margin traders on exchanges, they borrow US dollar to buy Bitcoin or Ethereum, and they have to post a collateral. Generally, that collateral is 110 to 130% of the value that they're borrowing, really. So, one, you are protected against sudden market moves, obviously to a certain extent, 10 to 30%. But two, you're dealing with a top centralized exchange entity that actually applies the DeFi model to your loan. So this strategy has been working for 5 years. I mean, it's probably been in the range of, I think it was on the range of 18% growth, 13% net, but I was going to say it's probably like 2 to 3 times the average kind of Aave to compound lending rate. So you could still provide a multiple of DeFi kind of yields, the lending platforms that you get on DeFi, using the DeFi model on crypto exchanges. So that we found interesting. And another way, obviously, to look at DeFi is obviously via staking, but you need to understand your risks in staking. Obviously, generally staking works to provide security to networks, right, by the proof of stake consensus, and generally the ones that allow you to do staking on their native platforms are smaller layer ones. So you have to carry the smart contract and blockchain kind of inherent risks there. So that's also a way of generating yield. You can also do crypto lending on centralized exchanges, right? Last couple of weeks, for example, we've seen very good projects such as Cosmos, for example, a layer 1 project, lending yields going up to between 15 and 20% a year. So obviously, if you're happy carrying the counterparty risk of that exchange, then you could add some nice yield on top of your holdings, right? Obviously, if you have long-term view about that layer 1. So yeah, so you've got lending, which you can do in centralized exchanges or in DeFi platforms, but depending on the risks you want to take, the counterparty risk of your exchange, or the protocol risk of the native decentralized finance protocol. And you also have staking, right, which you can also do on exchanges as well, but you can also do on native protocols.
A very thorough answer. Hans, has that left you anything to add on to, or is it quite comprehensively covered?
No, it's comprehensively covered. I think just for the market neutral strategy, to make it market neutral, because of course you can stake on the, let's say, with the native L1 tokens like Ethereum, Polkadot, and Solana and the likes. But if you want to do it in a market neutral way, because the main risk is your price risk, and if you want to do it in a market neutral way, you would have to do the dynamic hedging, which makes it much more complex and quite expensive as well. So there's interesting ways, I guess, apart from just the US dollar, the stablecoin yield farming, where you get the fees and interest plus a certain number of native governance tokens, which you can then sell or redeposit and reinvest again. It is that's where the smart risk, the smart contract risk is by far the highest risk still. So you have to make sure that you do indeed have a proper diversification among blockchains, among protocols and liquidity pools.
I love that diversification. You're going to hear that a lot from me as well throughout. I mentioned it at the start and I'll mention it at the end. So diversification is a word we like. So I guess I'll jump on to last 2 questions before we sort of have a summary and open it to the audience. So Alan, one for you really. Wouldn't be sort of a webinar without touching on quant models and quant funds. Question around the trading approach in different markets. So currently we're in a bear market. At times when there's a bull market, at times when the market conditions are changing, are there differences in your approach as a quant trading fund to different conditions? So I guess that's really a targeted question for you, Alan.
Yeah, so I would say for us as a quant company, we collect a lot of data, and we should remember that trading in the crypto space provides like 3 times the data that you have from the capital markets. We're operating 24/7. There's a lot of data. So as you said before about dog years, we tend to say that every data for 1 trading year in the capital markets, we have it for 3 years in crypto market, because it's like ongoing. Now, based on that, we have a lot of data from ups and downs, and we've of course back tested back to as early as 2017. So we've seen the highs and the lows, and at the end of the day, what we're looking for is for a human behavior. So it doesn't really matter if it happened in 2017 or 2018. We're looking for returning patterns in the market that are happening because the market is going down, the market is going up, and so forth. The challenge, the big challenge is to adapt yourself all the time to the evolving market, because we see that there's a lot of changes. As we said, there's a lot of new players coming in, making the market much more efficient. And now maybe the windows where you were able to see a momentum, because at the end of the day, we're momentum-based strategies, are narrower maybe this time, or maybe they are a bit different. So this evolvement with the market, which is, I guess everyone can agree, it's market on steroids, like everything that's happening is happening so fast in our market. So this is like the big challenge, but at the end of the day, it doesn't really matter if we're talking about highs and lows, it's human behavior. And human tends to, you know, go and this market is more, I would say it's a more trendy than any other market. You know, people are going in Reddit, talking about a certain thing, markets are going up, talking about a certain thing, markets are going down. So this is a very, very interesting environment for us. It doesn't really matter where the direction of the market is going.
Okay, excellent, good answer. So earlier on, you mentioned before, Alan, you were again stealing my thunder when you mentioned BlackRock's into the market. I think it was yourself anyway. Just want to ask, I guess with Matt, really, I guess this time, we hear noise about institutional investors. For example, as Alan said earlier, BlackRock announced a partnership with Coinbase to offer their clients access to Bitcoin. We've heard other leading private banks talking about accessing the space. So a question that's come from audience pre-call, which is why it's on here, is to what degree are institutional investors on board in this space, and how will they influence the market going forward? So I'll open that up to Matt first.
Yeah, I mean, I think it's like kind of been this phrase that people have said for years, like the institutions are coming, they're coming. And I think that's correct. I would actually say the institutions are here, and some of them have been here actually for several years, at least the forward-thinking ones. What I think people don't recognize is that it's not a plateau. It's not like a big tidal wave that comes all at once, right? People get comfortable with the space at their own pace. And they come in over time, and they come in through different strategies. And like, it takes time to build that trust and to build enough sort of knowledge of the ecosystem to continue to get sort of more exposure to it. And I think for us, like, we have at this point every type of investor you can imagine. Like, pick a group, and like, I can guarantee we have at least one of them in our capital base, from endowments and foundations to family offices and global macro and venture and crypto native groups and developers and funds. Like, I mean, it's an extremely diverse list. We just had our summit, our sort of annual summit that we do a couple of days ago in New York, and 500, LPs and folks from various institutions, major bulge bracket firms, like, all showed up for it. Like, I was sort of blown away by the attendance and the people around the room. And so I think the short answer to your question is they're here, and they have been, but they start small. And they understand that this is a space they want to understand. They want to have skin in the game. They want to find the right partners. And the idea is to grow over time, right? They don't have 500 basis points, in this sector today. Maybe they have 10, maybe they have 50, maybe they do venture, maybe they do liquid, maybe they do passive, right? So maybe they do quant, right? So there's a lot of different strategies. And I think all of these folks have a really strong knowledge of crypto that would actually surprise you. The question is, how fast do they scale up, and what are the various types of exposures that they want in their portfolio?
Excellent. That's good. Very, very positive. I think certainly from our side at Block Asset Management, we're seeing the same. I mean, we've had to create new share classes to accommodate institutional investments, and that's a good sign. They are, for us, they're here now. They're starting to arrive. And I know for other funds, particularly US-based, the US institutions have been in force a lot longer than maybe the more traditional areas within Europe and UK, who tend to lag behind what the US institutions are doing. So we're seeing it as well. It is positive, and that will lead me on to, I want to ask each of you, just as the last question before we'll try and squeeze in one or two from the audience, is just a sentence or two really as to the audience as to why they should be positive, or why, if they don't have skin in the game, why they should be positive about the digital asset space, despite where we are in the market right now. Why do you remain positive, let's say, about the long-term future of the asset class? So I'll run through back to the start in alphabetical order. Alan, your reasons for positivity in the digital asset space.
Yes, so I think we're just at the beginning, and there's growing pains. We need to remember that Bitcoin started off at 2008, okay? Ether came into play in 2015. This is very early. I think even coming today are, people coming into the industry today could be considered not as, the earliest adopters, but still as early adopters. There's still a lot of smart money that should come in. We do see, as we said, the institutional starting to look at this as another way to diversify. Okay, we see a lot of good projects coming in, a lot of great minds moving. And I'm not a big technology guy, I should say that, but we're talking about the blockchain as the next big thing. It's the next internet. Okay, so it will take time. We know that internet took a couple of years or more in order to get to where it's at. So I think it's put your stake in the game. As when I purchased my first Bitcoin, someone told me, listen, purchase it now. It's a bit cheap right now. If it will, come to if it fulfill what it's supposed to fulfill, your kids will thank you. If not, you lost a little money. So I think this is where you should look at it. It's all still experimental. Don't put all your money in it. Put 1%, put 2% in it, but be there. You don't want to be there when the market is booming and then you say, oh, I've heard about that, I understood, but it was, I don't know, I didn't touch it yet. So this is my take on this.
Hans, over to you.
Yeah, very good. Well, as I said in the beginning, we clearly see this as a new asset class. So people should get off zero and at least dip their toes into it. And interestingly enough, actually, if you look back 4.5 years when the fund started as well, the reasons to get into crypto were almost the same as they are now. There's a lot of, it's still a nascent and immature technology. There's a lot of capital that is there to be deployed and has been deployed already. A lot of smart people all across the world that are developing and otherwise involved in the ecosystem. And actually, on a more positive note, is that regulation has over the years become a lot more clear. There's still a lot of headwinds and a long way to go probably, but it is much clearer than it used to be. So our conviction hasn't changed. It's long term. Be in there. Don't be driven too much by emotion. The innovation is happening. Innovation, as you just mentioned, the BlackRock and Coinbase, Fidelity, I think, is another one big player. The infrastructure is being built in bear markets, and you have to be ready, and the market will be ready to absorb the next groups of investors that will come in with the next adoption curve.
Lovely. Matt, why is the smart money coming in now? Why should we have exposure?
Yeah, I mean, look, to some extent, I think the strategy is almost like don't get too cute. The primordial soup is all there, right? Like follow the talent. I mean, there's world-class folks leaving, Web2 and major tech companies to build in this space. There's clear macro tailwinds around just sort of lack of trust of legacy institutions. A whole new generation is sort of growing up, transfer of wealth, all of that. You're talking massive addressable markets here with immediate global reach, and things are working. I think if I look back to like 2018, 2019, there was a real chance that like this wouldn't work, that people wouldn't care about decentralization, that developers wouldn't build anything interesting, that users wouldn't take the time to figure out how to use this tech, which is admittedly somewhat janky from a user interface experience. Fast forward to today, like I think all of those risks have been mitigated. Like I think the only real question is how big does the space get and what path does it take? And if crypto is going to permeate into sort of everything, sure, it could be volatile over the short term, but like that's the price to pay to generate, venture scale upside. And so that's been the case historically. I think that'll be the case moving forward. Frankly, the space is in a much better spot today than it's ever been before.
Couldn't agree more. And Samed, over to you.
Yeah, sure. I mean, what's obvious is that it's a nascent technology, really, right? So, and with every nascent technology, it's going to be super volatile. You're going to see outsized returns both on the upside and the downside. So, obviously, you need to understand that as the industry matures, those outside returns will kind of shrink, and you'll see more low, smaller variations towards the mean, right? But what you have to not forget that with every new technology, you need to let it time to kind of fulfill its full potential, right? I mean, look at Amazon, right? Amazon, I think in the early 2000s has had three massive drawdowns. The first one was 95% drawdown, then I think 70 or 75%, and then I think around the 60 to 50% drawdown, right? And yet, if you had invested, I think less than 1K in each of these drawdowns, I think you'd have accumulated $6 million now, right? So, and nobody believed in Amazon at that time. Nobody saw the need of doing all your shopping and everything else online and having it, shipped to your door the same night, right? Again, here is the same. We're kind of looking at the same nascent technology. We have only onboarded a tiny percentage of all the financial assets that are out there, right? We're talking about $300 trillion of financial assets. So there's a huge potential of kind of onboarding that on chain and involving, the peer-to-peer kind of composability, communication between all these chains across various participants, right? Be it peer-to-peer, etc., or institution at the institutional level. So yeah, I'm super bullish, and I think more so now because as Matt I think was saying, it is not the shitty ICOs that we were saying in 2018, right? Everything was going to zero. There's no utility, etc. Now we're really seeing real world utility, right? From combating counterfeiting to DeFi, basically, right? From a few thousand users back in 2018, we have 200 million users using the space. So yeah, we're only heading west, frankly, and you should be invested. That's the opportunity cost really is not to be invested in the space, I think.
Another great answer. Right, conscious of time, so I'm going to jump on to two questions that have come in from the audience. So this is just open to the panel. Whoever wants to tackle it, fire away. The first question is, do the panelists expect to see high attrition across the crypto fund universe given the route? Do we expect to see high attrition across the crypto universe?
I think yes, like to some extent. I mean, it depends on your definition of high. Maybe it's not high, and it also depends on what you're talking about, right? I think on the venture side, I think you're seeing a lot of emerging managers pop up, and they have more defined, cash flow and management fees, and they're pretty lean. So I think now's you're seeing a lot of that. For funds that are in the space, I mean, I think this sort of shows like how important scale is. If you had $100 million fund and now you have a $50 million fund, over the last 6 months just because of a drawdown, if you're subscale, it's hard, right? You've got limited management fees. You want to hire and attract talent and retain talent. You've got high watermarks, right? So I think you're going to see some natural consolidation and folks leave and do things. We saw this in 18 and 19. There were some fairly high profile funds that, either collapsed or folded or mismanaged risk, et cetera. So I think it's natural and it's sort of healthy for the marketplace anyway.
Perfect. Good answer. Just on that kind of helps me lead into the next question here, which was, and I think I'll have to tackle this myself, it resonates directly with Block Asset Management. Are you open to diversifying your portfolio with other funds? Is it a good time to form a fund of funds structure in the market now? So, as the intro at the start, we at Block Asset Management, we manage a fund of funds, the world's first digital assets funds. And as you've heard here from the panelists, there are a number of different strategies, and the asset class is now very diverse. Hence I picked up on the diversification, the word that Matt mentioned earlier. So that is a key parameter, that how diverse the asset class is now, and how many different, not just tokens, digital assets, or cryptocurrencies, whatever you want to call them, but different verticals that exist within digital assets, whether it be fundamental trading, quant trading, whether it be taking returns from fixed income style returns and sort of lending, staking strategies, whether it be your direct exposure or long beta exposure, or whether it be VC and PE style investing. There are many different verticals within this space now. Some managers better than others. Here today we have 4 of our selected managers that have passed our stringent due diligence. So to answer that question, we personally have always been big believers in diversification and felt that a fund of funds was a must in this space. We were the first, but we know now there are 20, 30 plus now in this space. So yes, to answer the question, it is a good time. It was always a good time given the lack of understanding that was in this asset class when it first started and become really an investable asset class, probably around 5 years ago. Even more investable now, as we've all adhered to that, 3 or 4 years ago, there was still a big risk of things failing or not working out. Whereas now we're looking at the adoption and the number of users. And I think we've all adhered to that. We now feel very strongly that those fears that might have been in place 3 or 4 years ago have fallen by the wayside now. So yes, the fund of funds, definitely a great strategy. We are the first. We were the best performing over the last couple of years as awarded by Crypto Fund Research, but there are others out there. So just due diligence, diversification, and pick the right managers. If you are going to select a fund, pick the managers, do the due diligence. So just one more question, all we've got time to is, we've got one here, which tokens are we buying now? That's a difficult one. We'll go past that. We're not here to do individual tokens we're buying. I'll go down one more. Crypto is undoubtedly the future. How much will it be part of our lives? Will we move to a totally digital and decentralized area? Are we talking metaverse here? What is your vision about that? Thank you. So how digital are we going to go, gentlemen? As a close, last question.
I'll just give my, a nice analogy that I like. It's for us, the parents of us here. Okay, if your kids are playing, for example, Fortnite or Minecraft, they're already using virtual money. Okay, they're trading money for stuff. So yes, it's not blockchain, but they're doing what the asset space is supposed to do, and they will be the future. Okay, so they will not see cash anymore. They will see something which is very different, and they will replace it between themselves. You see it in Roblox, in as I said, in all those games. So to say that if it will be a part of our life, it will be a big part of our life, because we are, unfortunately, a bit old. They're taking over the place, the millennials and the guys that will come after them, and they're in there. They're already in the game. Okay. This is what they know. This is how they know to interact. So we should understand that this is the place to be. So this is my take on the matter.
You say that, as you might have heard my son come in the back of the room and shot upstairs, already on the computer games, I'm sure. It's a good summary. I won't jump through, guys. What I will do, we're now at almost 4:25, so we've almost gone an hour and a half. So that leads me to say a really big thank you to everyone, Alon, Hans, Matt, Samed. Thanks for a great discussion. Thank you for your time, your thoughts and your knowledge on all of the topics that we've discussed. To the audience, thank you for your time. Hopefully you found it to be interesting, worthwhile and educational. Clearly it's been evidenced today, as I summarized earlier, that it is a diverse universe, digital assets. Diversification, we believe at Block Asset Management, is key, but also hand in hand with that is thorough due diligence, selecting best in class, examples being the managers we have here today. You need to do due diligence. I would also follow that with diversification and active management. I think those three principles are paramount in this asset class, and we at Block Asset Management hold those three principles at our core. So if you'd like any further information, please contact me. If you'd like contact details for any of the managers, please contact me. And it just leaves me to say a big thank you to everybody. Thank you for your time, and we look forward to another webinar next quarter. Thank you, everybody. Take care.
Thank you.
Thanks, Kevin.
Thank you.
Bye-bye, everyone.
Bye.